and thank you for joining me today. My name is Wesley Boudreau, one of the financial advisors here with the Retirement Group. Today we're going to go over tax planning strategies associated for Occidental Petroleum employees. Before I get started, I just need to remind everybody that the Retirement Group we are not affiliated with, nor are we employed by Occidental Petroleum. Now, if you have any questions throughout this webinar, there is a Q&A box there. Feel free to put that information in there. I'll be happy to address it at the end of the webinar. And keep in mind your information is anonymous, so it will not display your name or anything of that nature. There's also a chat box where we will be dropping some information in there throughout the webinar. Different things like how to follow us on LinkedIn, how to set up an appointment, things like that. Also, you may get a survey at the end of this just asking us how we did. Please do us a favor and take some time to fill that out so we can make sure there's any changes we need to address for future webinars. All right, now before we get started, for those of you who do not remember who the Retirement Group is, again, we are an independent financial advisory firm that focuses on working with corporate employees and helping them transition into retirement. We've been doing this for just about 30 years or so. We work with about 20 some odd companies, and Oxy is obviously one of the companies we do a lot of work with. The reason we focus on few companies is it allows us to have a deeper understanding of your benefits plans inside and out. So that way we can hold your hand through that process and help you avoid a lot of common mistakes we see from time to time. We've got offices throughout the country, so rest assured if you need to sit down with somebody face-to-face, that can probably be accomplished as well. But obviously in these current times, we can do webinar meetings, phone calls, emails, fax, all that stuff as well. And at the end of the day, if there's anything you take us up on, it's going to be our cash flow analysis. That's a complimentary review of where you stand, and it will help you determine the best day to retire and let you see what things look like not just now, but in 10, 20, 30 years down the road as well. And it's very important to look at this before you actually make any decisions as to when to retire, and then what the next steps are in that retirement process. Now, getting into some of the taxes, let's first talk about some recent tax changes that happened last year in 2020 thanks to the Secure Act. Some are positive, some are negative. But there are some affected, pension plans and 401k plans. But the ones that were most appropriately affecting individuals were change in required minimum distribution, the changes to the contribution options based upon age, and then also the removal or the change of the stretch IRA, which is definitely a significant one. So let's go through these. First off, the one benefit they did do is they pushed out the required minimum distribution. It used to be 70.5, now it's going to be 72. So it gives you an extra year and a half of potential tax-deferred savings if you don't need to take any assets out. That also gives us some additional years of tax planning strategies we'll talk about a little bit later as far as Roth conversions and things of that nature to help minimize your taxes for yourself and for your beneficiaries. So that's a positive there. Now, one big negative, and unfortunately I have had to go through this twice already this year, once as early as mid-January, so as soon as they enacted this. What they did is they changed the stretch IRA options, where it used to be that if you left the money to somebody other than your spouse, they still had the ability to actually stretch out that IRA based upon their age. So they only had to take a little bit each year, which helped keep them down in a lower tax bracket. Now, I mentioned before, I just unfortunately have had two different clients pass away this year, both in a situation where they had previously gone through divorces and had their kids as the beneficiaries. One happened early January, so just as this changed. And so the new rule, what they have to do is they have to take that money out within 10 years, whether it's all in the first year, all in the 10th year, or 1/10 of per year is one of the best ways to kind of stretch that if you would. The difference though is it's less stretching, and so it means you have to take out more. So the risk there is even if you have your spouse as a beneficiary, chances are eventually you may die, then your spouse will probably name the kids as beneficiaries. So eventually some of this money may go to non-spousal beneficiaries, and they're forced to take that out within 10 years. So what that means is they may be forced to take out a higher amount while they're actually still earning income, and so that increases the tax revenue for the government. So this is definitely something to look at. Even if you have a spousal beneficiary, we can have a conversation about some planning strategies to help reduce this down the road. God forbid something does happen to you. Now, another thing that was actually a positive was actually the removal of the age limit. It used to be that tied with the required minimum distribution at 70.5, that used to be the max age that you can make contributions to IRAs or Roth IRAs. Now that's been eliminated, so you can be 80 years old, working at Walmart or Home Depot or something still, and you can still make contributions to an IRA. So that's definitely a good positive. It can help in a lot of tax planning strategies as well. Now there's some other things that have not come to fruition yet, but have been talked about in the Biden administration, different changes to long-term capital gains rates, also some changes to NUA potential. So once we have some of this information, we'll be happy to go over it with you. But it is definitely something to be aware of in planning strategies as well, along with some different potential changes to the tax brackets. So let's first talk about some different things that we see from time to time for Occidental Petroleum employees, some different benefits as far as helping them with that transition and helping them manage taxes so they can keep more in their pocket versus giving it to Uncle Sam. So first and foremost, once you do retire, you've got your pension and your savings plan. And then you've got that ability to actually roll this over to an IRA. If you were to take a distribution to yourself, it's going to be fully taxable. From the 401k, it's going to be taxable, and there's going to be a 20% withholding. If you were to roll that over to an IRA, it's simply just a transfer from one tax-deferred account to another. So there is no taxes, no withholding, and there's no tax to physically take that money out to yourself. And then from an IRA, you've got a lot more flexibility when it comes to investment choices. If you want to work with a company like the retirement group, you have the ability to work with a company. Also, when you do take distributions, you can dictate what your tax withholding would be. So this is one of the first things we see a lot of individuals do if they're looking for more flexibility outside of the 401k and the retirement plans. Now, one of the other things that we do a lot of work within the 401k plan is focusing on kind of a backdoor Roth contribution option. Right now, you're limited as far as how much you can make in contributions to a Roth IRA, and depending upon your income, you may not even be able to make them, period. However, if you make after-tax contributions in your 401k, this is where you don't get the tax deduction right now. So let's assume somebody's making $100,000 a year, and let's say they put in 10%, so they put in $10,000 on a pre-tax basis. What that shows up is it means they're getting that deduction, so they're only making $90,000 for that year when it comes to taxes. So they're saving tax on that $10,000. However, down the road when they're retired, they're going to have to pay taxes on that plus the earnings. On the flip side, if you do an after-tax contribution, you do not get a tax deduction on that $10,000 right now. And then as it grows, all their earnings will grow tax deferred, and those will be taxed when you take it out. However, that initial cost basis, that $10,000, is going to be tax-free whenever you take it out. Now, if you've built that up or you want to build it up, we have options where you can actually take that $10,000, for instance, each year, and roll that over to a Roth IRA. So now you've got more flexibility as far as investment choices, and that $10,000 in this example will start to grow tax-free as long as you keep it there for at least 5 years and you wait till age 59 and a half. So in theory, you could put $10,000, $20,000 or so a year if you wanted to in a Roth IRA under this mechanism. So give us a call. We'll be happy to go through the different options for the Oxy plan on that as well. Now, as far as when it comes to taking distributions, generally speaking, what's going to happen is the bulk of your assets in a 401k or IRA are going to be tax deferred, so you're paying taxes when you take them out. If you take them before age 59 and a half, there's a chance you could also pay a 10% penalty. However, there are some different ways around this. A lot of those different things are if it's for post-secondary education expenses, first-time home purchase, some medical expenses based upon the amount. But generally speaking, it's going to be a 10% penalty before 59 and a half. There are 2 rules that are beneficial, though, where you can avoid this. And the best is if you retire from Oxy at the age of 55 or later, you can actually take distributions under the age 55 rule from the plan without the 10% penalty. So be very careful if you're talking to an advisor and they're telling you to roll everything over to an IRA, because that could change your tax treatment. Let's assume that you retire at 57 and you've got $500,000 in the 401k plan. If somebody tells you, hey, roll everything over to an IRA so we can help you manage it, once you move that to the IRA, you lose that age 55 rule. So any distribution from there is going to be taxed plus a 10% penalty if it's prior to age 59 and a half. So if you're working with a retirement group, we would honestly recommend as fiduciaries to keep money in that 401k plan in case you need it, so you can take that without the 10% penalty. Now, if you don't have a choice and that money's already in an IRA, there is another 72T rule, which allows you to take it out based upon substantial and equal periodic payments for at least 5 years or until you turn 59 and a half, whichever's later. Now, but by doing that, you have to follow specific IRS regulations, and it's based upon a calculation, so you may not be able to get the amount you want to get out. And if you make any mistakes in it, they can retroactively penalize you there. So we've done a lot of this. You need to make sure if you have to go through this route, you work with a company like the retirement group who has extensive experience. Because again, if you make a mistake, they can come back and retroactively penalize you, and that could cost you thousands or tens of thousands of dollars, depending upon what you're doing. Now, again, we mentioned before the required distribution age changing from 70.5 to 72. So that gives you flexibility between 59.5 and age 72, where you can take distributions as you see fit. So again, at age 59.5, there's no 10% penalty. And then at age 72 now, whether you need the money or not, you're forced to start taking that out. What they do is they take a look at your age and use a divising factor to determine how much to take out. Generally speaking, the first couple of years, it's roughly around 4% of the portfolio. So let's say if you have $1 million, in all your IRAs wrapped up, or 401ks, everything combined, you'd have to take out about $40,000 a year, whether you need it to or not. So depending upon your situation, you may be taking more or maybe taking less, but you're forced to take it out. So that leads us to some different tax planning strategies between age 59.5 and age 72, where we would recommend looking at Roth conversions, where you can actually convert some of your money from your IRA over to a Roth IRA and allow that to start growing tax-free. So that will actually reduce your amount that you're forced to take out at age 72, because we have no idea where tax brackets will be at that time, but chances are, obviously, if you're not 72 right now, they're going to be higher down the road. So it's best to look at planning for that. And this is something we sit down with our clients and go through towards the end of every year, October, November, so we know what's happened throughout the course of the year and there's no surprises. But there are definitely some options to save tens of thousands, if not even $100,000 or more in taxes for yourself and your beneficiaries under a strategy like this. Now, let's take a look at the tax brackets. And this is obviously kind of busy, so let me kind of zoom in here so you can see a little bit better. But if we look at the tax brackets for 2021, and let's take a look at what I just mentioned, that Roth conversion option. So let's look at the 12% tax bracket, that second line down there. And let's take a look at maybe a married couple. If we scroll to the right, what we'll see is that they cap out at $81,050 is the top of that 12% tax bracket. Beyond that, it jumps to 22, so that's a pretty big jump. It's a 10% jump for any incremental income above that. Now, when you factor in the standard deductions, that gets their AGI up, close to about $105,000 or so that you can actually have of earned income before you jump to that 22% tax bracket. So in that example that I mentioned before, Roth conversion, let's assume that couple maybe only needs $60,000 a year to live on. So that means they've got another $45,000 that they could actually take out and pay 12% taxes before they jump up to the 22% tax bracket. I would strongly argue that 12% is probably going to be the lowest tax bracket you might see. So we would probably recommend to them to take out $40,000 or so, convert that to a Roth IRA, pay the 12%. Now that will grow tax-free for the rest of their lives, and that will reduce their potential required distribution as time goes on, and it'll help benefit them as well as their beneficiaries. And they could also do it if they bump up in the 22, or even all the way, if you have $1 million, you could do $1 million all at once if you want to. But keep in mind that's going to bump you up into those higher tax brackets, so that break even is just going to take a little bit longer before you recoup those taxes on there as well. We've also got the long-term capital gains on here, which is important for taxable accounts, and especially if you exercise NUA, in which case you can look at long-term capital gains versus ordinary income. However, there are some discussions about this potentially changing as well. So it's best to run that cash flow analysis and look at your situation and let you know if it will affect you or not. Now, at the end of the day, I mentioned again that that cash flow analysis is very important to take us up on that. Right now, about 3/4 of Americans over 50 don't even have a written plan. If you can spend about maybe 10 minutes with us, we'll gather a little bit of data, give us about a week to 2 weeks, and we'll get that report back to you. And it'll be a very detailed cash flow analysis to show you where you stand right now and help you determine the best day to retire. You can look at multiple choices as far as retirement dates, different spending options, things like that. But we can at least give you that plan, show you where you are, and help you determine the best day to retire, which in turn can help you determine some of the best investment strategies for both your 401k and IRA if and when you do retire as well. Now, at the end of the day, obviously we'd love to work with you. We'd love to make you a client. We do understand if you're working with somebody else, and that's great. It's good you're getting help. We do recommend getting a second opinion just in case. We even recommend our own clients do this periodically just to keep us on our toes. But make sure the person you're working with has a deep understanding of your benefits plans because, again, I can't tell you how many times we've seen individuals who already have an advisor make some of the same mistakes that we see individuals without an advisor just because that advisor does not know the Oxy plans very well. And then make sure you understand the fee structure. You're going to be paying fees regardless wherever you go, whether you stay in the 401k or go to an IRA and do it on your own or work with a company. It's just a matter of how much are those fees and what are you getting for those fees. At the retirement group, we are fiduciaries. We're transparent on our fee structure. We're not a one-size-fits-all firm where everybody goes into the same cookie-cutter approach. Our goal is to dig into what your goals are and your risk tolerance and determine the best fit for you and provide you choices. But on the managed side, our fees start at 1% and go down from there. So most of our clients are paying much lower than 1% depending upon the situation. And then just figure out what is it you're looking for, what's the best value you're looking to capture with an advisor, and let us know, and make sure you're working with a team approach, so that way there's individuals behind the advisor supporting them as well, because myself and the others here, we can't do everything on our own. We need back office support. We need support on the investment side as well. And then at the end of the day, you need to run that cash flow analysis and make sure that before anybody makes a recommendation to you, you've run an analysis and you run it from a conservative standpoint, and that way you can truly know what you're looking for before you make any decisions as far as how to invest and what to do with your retirement money. Now, again, if you have any questions on this, feel free to give us a call, and you can reach us at info@theretirementgroup.com or call us at 1-800-900-5867. There's also, if you have your cell phone, you want to hold up, there's 2 QR codes. There's one if you want to schedule an appointment with myself or one of the other advisors here. And there's also one if you'd like to follow us on the LinkedIn page. That way you can get some updated information on the Oxy plans as things change, and notifications of future webinars here as well. And then with that, I want to just turn it over to some of the questions that we did have come through. And it looks like we've only got one question coming through. And okay, so the question is can I still roll over at age 72? So I don't know what that question is specifically asking, but yeah, depending upon it might be because somebody who's still in the 401k plan. So if you're still in the 401k plan and you're at 72 now going forward, you're at the required minimum distributions for the plan, so you're forced to take out that distribution I mentioned. So let's use simple math again on that. Maybe you've got a $500,000 401k plan, and let's say that you're at your first year of distribution, so it's roughly 4%. What would happen is you would have to exercise and take that required minimum distribution first. So you'd have to take out about $20,000 as a distribution. Once you've done that, then you can roll it over to your IRA. So again, yes, you can continue to roll it over. It's just that the IRS requires you to satisfy that required distribution first before you process that rollover. And again, obviously, if you're younger than 72, it's important that we sit down and talk with you, because I mentioned before, between age 59.5 and age 72, there's a lot of planning strategies we can look at as far as helping you minimize that potential required distribution as well. So with that, I want to, again, thank everybody for taking the time to join us today. And again, just give us a call at 1-800-900-5867. We'll be more than happy to answer any questions and set up an appointment or run that cash flow analysis for you. So I want to thank everybody for joining me, and I hope everybody stays safe.